as a financial advisor, I have a front door seat in seeing how the economy is impacting people's lives here in America. And unfortunately, I do think life is getting harder for many of us. The reality is many people's salaries are not keeping up with inflation. Prices are rising for all of us, and it's beginning to have an impact on us. And some of the resulting statistics from our personal finance and from our retirement situation are getting scarier and scarier. In fact, as I record this, just recently, Wells Fargo released their 2024 money study where they surveyed about 3,500 Americans and about 200 teenagers. And what they found, frankly, is startling. 2/3 of Americans are cutting back on our spending because of our concern about the economy. Almost half of us are putting some life plans on hold, and almost a third say that we have enough to pay our bills, but we don't have much for extras. So let's look into this study. Here's some of the results from it. Again, cutting back on spending, about 2/3 of Americans. Over half of us are worrying about money. Almost half of us are feeling nervous about debt. Almost half are delaying life plans. We're making tough financial decisions, again, about half. We're putting more into our savings and investments, which is a good thing, right? We're doing that as a security blanket, just in case something happens. Unfortunately, another third of Americans are dipping into their savings and investments. And only about 25% are making some large purchases. Almost 25%, I think this is a good thing, obviously I'm biased, are seeking advice from others, and only 20% are taking new financial risk, which is one of the ways that America grows, right? That we back entrepreneurs, we back people that are doing things to make things better, faster, and cheaper. And hopefully over the long term, we all benefit from that. Okay, so there's another study that was done that looks at what percentage of Americans feel that they're doing at least okay financially. And you can see since 2013, that number was steadily rising until 2021. Overall, I mean, of course, during the pandemic, that was a scary time. We saw it dip, but in general, that number's gone from about 60% to almost 80%. But now it's dipped down to the low 70s. And the most recent data is from 2022. Okay, and these are the main challenges that people are reporting. So obviously inflation, and this is a comparison between 2016 and 2022. Obviously, we're all worried about inflation. Yes, inflation has come down, but it's still positive, and it's a good thing for inflation to be positive, but not at the level that it's at now. A healthy amount of inflation. The Federal Open Markets Committee, Jerome Powell and his group would say a healthy inflation rate is about 2%. And we're somewhere between 3 and 4% right now. Now, the good news is we've come down from about 9%, but it's that last mile of inflation that can be really hard to conquer. So we're generally hearing news that right now we should be expecting interest rates to stay higher for longer than we were all hoping. We were all hoping there would be this spike of interest rates, prices would come down, inflation would be tamed, and then we could go back to having lower interest rates. I'm not saying back down to the mortgage rates of 3% in that range, but come down from the 7 to 8% range that they've been recently. So that's what our hope was. Unfortunately, it looks like our journey is going to be longer. So again, looking at these self-reported main financial challenges and the differences between 2016 and 2022. Inflation obviously is a big one. General needs is also just our general spending. Everything is going up, in particular food, right? I think we're all seeing that in the grocery store. You can see retirement and savings has become harder. I talked about that earlier, about how it's, many of us can meet our bills, but we don't have much left over after that. Housing, this doesn't look like a big increase from 7 to 10%, but that's almost a 50% increase, right? If we had 1,000 people, 70 people were worried about, 70 people were worried about it before, and now 100 people are worried about it. So almost 50% more. Employment, that's been a bright spot here, is unemployment has stayed historically very low despite the higher interest rates. So that's been a good thing. Medical, it looks like concerns are going down a little bit. Debt concerns are going down. Frankly, that surprises me. With the higher interest rates, I would think that debt would be a bigger concern. But I think a reason for that is because many of us have locked in our biggest source of debt, which is our mortgage. Here in the US, we can get a fixed rate mortgage where it stays constant over 15 or 30 years. Education, it's a little bit lower of a concern, and it might be that these other concerns have really been the wind has been sucked out of those other concerns because so many of us are focused on, rightfully so, focused on inflation. And you can see people reporting that they really had no financial concerns. That was about half of Americans in 2016, and it's about a fourth of Americans in 2022. Okay, so what else do we have here? According to Bankrate, they claim that to feel financially secure, Americans need a salary. Now, I need to say that I disagree with this conclusion, but they say that Americans need a salary of almost $250,000. It's $233,000 a year. And, that's a huge number. That's over 3 times the median U.S. household income of about $71,000 a year. So what Bankrate did was they looked at our expenses and said, okay, to be comfortable with these expenses and to save up the type of money that unfortunately is pretty much on our shoulders now to save up for retirement. Remember, in the past, the retirement foundation, the retirement stool, if you will, had 3 legs to it. Many folks had a company pension. For many of us, unless you work for the government, municipality, or in a university setting, for most of us, we don't have a pension anymore. So one leg's completely gone. Another leg of that stool is Social Security. And we know that Social Security, unfortunately, is in a difficult situation. With Janet Yellen saying that Social Security will not be able to fund 100% of the benefits starting in 2034, which, as I record, this is only 10 years away, which politically is a very short period of time. Now, that doesn't mean that Social Security goes to zero, but Janet Yellen has said the current taxes being paid into Social Security will only be able to fund 70 to 80% of the benefits of Social Security. So where is that other 20 to 30% going to come from? And the reality is we don't know. So again, that 3-legged stool, the pension is gone for most of us. So now we have a 2-legged stool. And Social Security is rocky. I think we'll figure out a solution for it. I don't know. I certainly hope so. But for many of us, Social Security, a big piece of our Social Security is going to be taxed. The last piece is really the retirement savings that we put aside. And that's where Bankrate comes up with this $233,000 a year. So I said at the open that our salaries are not keeping up with inflation. And why do I say that? This chart here by the Federal Reserve, it's called the Fred Report, shows what earnings have been since 1975, our salaries, I should say. Our incomes, and you can see in general there's been dips like 75 to 1980 it actually went down, but since 1980 it's been on a pretty steady rise. We see that blip here with the great financial crisis starting in 2007, dipped down, but we've had a nice increase since then. But if you look at it on an inflation adjusted basis, now the good news is the numbers still go up until about, about 2020. And then in 2020, our salaries, even though if we go to the previous chart, the salaries keep going up, but on an inflation basis, you can see on an after inflation basis, we're actually making less over the last 3 years. Our salaries simply have not kept up with inflation, and that's why we're feeling this pain when we go to the grocery store. Everything has gone up, and in some cases, things have doubled since the beginning of the pandemic. I'll give you, for instance, my box of cereal, the type of cereal I like to eat, has almost doubled. And you know what? I don't think that price is ever coming back down, but few of us have seen our salaries double in the last year, right? We know that we had high inflation in the range of 8 to 10% recently, but few of us got a pay raise of that magnitude to keep up with inflation. Okay, this chart here by Business Insider shows how much do we need in order to retire. Now, this is a super simplistic chart, and I think it's misleading. So outside of Social Security, outside of your pension, this is it. In addition to that, so let's say Social Security and any pension is let's just use a number, $50,000, and you want $100,000 a year. The way to look at this chart is you've got $50,000 coming in from Social Security or your pension, so the other $50,000 has to come from your retirement savings. So we would come here and look at the $50,000 a year column, because that's what we need from our retirement savings. And that would say we need to have saved $1.25 million. So if you need $100,000 coming from your retirement savings, and on top of that, you've got Social Security and maybe a pension, if you need $100,000 coming from your retirement savings, you can see here, you would need $2.5 million. So another way to look at this is what I call the rule of 25. So if you needed $10,000 a year, just for easy math for me, you would multiply that by 25, so you would need $250,000. And this is for the 4% rule. So, obviously $100,000 is going to be 10 times that. So 10 times 250,000 is the $2.5 million. So that's how to look at this chart. But the next chart here by CNBC, and then also the source of this is Vanguard's How America Saves 2022 report. But this shows the median in the average of retirement savings account balances by age. Now, this is outside of our home equity, and this is also outside of any savings that we would have that are not tax benefited, tax deferred, or qualified accounts. So this would be money like in your local bank account or in a taxable account. It would not include your Roth IRAs, your Roth 401ks. It would not include your regular 401ks, your regular IRAs. But this is the retirement savings for those accounts, the 401ks and the IRAs. So you can see here, for people under 25, obviously they haven't had a chance to save much money. 25 to 34, as a median, they've got $14,000. 35 to 44, they've got $36,000. 45 to 54, they have a little over $60,000. 55 to 64, a little under $90,000. And then it goes down from there. 65 and above, again, a little bit less than $90,000. So, what this Vanguard report is showing us is that, unfortunately, Americans are woefully undersaved for retirement. Now, I think this underreports the total savings, as I said. It doesn't include your taxable accounts. It does not include your home equity. I do want to quickly point out the difference between median and average. The median is half the people have more, half the people have less. And we tend to use that when there might be outliers that are going to skew the data. Billionaires. If we had Elon Musk retirement savings here, it's going to skew that data. So that's why I think the median is better than the average. And you can see the average across the board is quite a bit higher for that reason. Okay, another thing that we have to look at is debt. So what is the average household debt? Average household debt. So credit cards, and credit cards are awfully expensive, right? It's oftentimes 20 to almost 30% a year interest rate on this, but the average household credit card debt is just under $17,000. That's an enormous drag, just that interest rate that we have to pay on that. That's an enormous drag for people. Auto loans tend to be much less expensive, but still can be expensive loans. It's $30,000 is the average auto loan. And I should say that almost 20% of new car loans are $1,000 a month or over. And the average new car loan, so the average loan payment, monthly payment, is about $730 a month. So for many of us, one of the least sacrificial ways for us to save more money is by buying a used car, and preferably, if we can, paying cash for that new car. So I'm sorry, for that used car. So if you can find a good, dependable car that presents itself well, that you can pay cash for and save yourself that loan, for many of us, that can be a really good trade-off that doesn't feel sacrificial. Because yes, it's awfully nice to drive a new car for the first couple weeks, the first couple months, but after that, that new car feeling goes away. But the car payment can stay with us for 60 months or longer. Okay, student loans, that's another huge drag. The average household student loan balance is over $50,000. That's a lot of money. And, you know, for the most part, student loans are something that never go away. You know, there are plans that kind of student loan forgiveness, or maybe after a certain period of time, student loans go away. But for the most part, as things are, as I'm recording this, those student loans don't go away. And so that's a big drag for people for a long, long time. It's surprising how many 50-year-olds still have student loans that they're paying. And then our mortgage payment, I consider mortgage payments to be constructive debt versus destructive debt, because we're using it to buy a long-term asset, and hopefully, you know, the value of that home goes up over time, not in every year, but over, you know, let's call it a real estate life cycle, which tends to be about 10 years probably. Hopefully over that period of time, we tend to do okay financially with our homes. Okay, so when people are surveyed and asked, you know, what's the main reason that you don't have any retirement savings? Because unfortunately, there is a rather large proportion of Americans that don't have any retirement savings. Almost half of people say that, you know what, I don't make enough money. And I have empathy for that, but I do think it's super important to save what you can. If you find yourself in the situation where you don't have any money to save for retirement, maybe one thing to do is, as you get a promotion at work, as you get a raise at work, as you change jobs and maybe make more money, half of that goes to your future self and you save it, and the other half goes to your current self. So that's one way to start saving. And I would say, and I know it's awfully aspirational, but saving closer to 20%, I think as a financial advisor for over 20 years, I think that's what we need to shoot for. I know many of us won't be able to do it, and we won't be able to do it for every phase of our lives. For instance, if you have young kids at home, and you know, kids are expensive, and if you're younger and your salary, you don't have the experience yet to command a higher salary. So you do what you can, but every year just try to save a little bit more, and your future self is going to thank you. So, you know, these are the reasons this chart here talks about why people don't have retirement savings. So that's the overall picture. Again, the biggest thing to do is do what you can, save what you can, and you're likely doing better than what you think you are. And that's why I made this video here saying you're probably doing better than you think you are. You're likely richer than you think you are. Thanks for watching this video, and I hope to see you in that one. Bye-bye.